Hey folks, welcome to Public Live. I'm your host today, JD Durkin, here with you to discuss the central bank's intentions to assist banks, the rising rates impact on the national debt, and the hyperinflation fears as they currently present themselves to the U.S. economy. Of course, as always, feel free to check us out over at Spotify at The Public Podcast and over at YouTube at Public Invest for more in-depth interviews to help keep your portfolio on track. Today, we're here with Cullen Roche, CIO at Discipline Funds, to help break down the potential hyperinflation risk within the U.S. and other challenges in the economy. Cullen, welcome. Nice to have you.
Hey, JD. How's it going?
Doing pretty well, unless you are an investor who's concerned about hyperinflation. It sounds scary, and a lot of investors may not even know when they're facing hyperinflation as it's actually occurring. So let's start with a base definition, if we can here, my man. Define hyperinflation for us, and what type of price appreciation needs to be experienced in order for us to officially say we're at that point.
Yeah, it's a word that kind of gets thrown around in large part because there isn't really like an agreed upon definition. I typically would refer to it as a 50% rate of change in inflation. So I think that for people who are listening to this, I think a good way to think about this is that hyperinflation it's a super extreme price change. So the way that I like to think of it is your standard sort of garden variety inflation is when the price of things changes between your visits to the grocery store. So when you visit the grocery store this month versus next month, you'll see the prices increase. That's an inflation. Whereas hyperinflation is when the price of the things in the store is actually changing when you're in the store buying those things. So we're talking about a really, really extreme price change that's happening very, very rapidly. And to be honest, I mean, any living American has not experienced what this is really like because it is an extraordinarily traumatic, devastating economic environment to experience.
What is the historical comparison, if there is a close one?
I mean, the 1970s, we got into a kind of like a 10 to 15% rate of change, which is still, I mean, we're talking about when you get into numbers like that, even like that's a pretty traumatic economic environment to experience. So, but it's that even that is not a hyperinflation is really, I mean, it's virtually like an entire collapse of like the currency basically that you're using in everyday economic life. So there's no keeping up with it. Basically, it's totally ruinous. Whereas the 1970s were really bad for the United States, but they weren't a complete collapse. They were, more of just a stagflationary type of environment where the rate of inflation is high, but not so devastating that the economy can't eventually overcome it.
I do want to ask you about the bank term funding program, sort of one of the backstops that we did get that announcement. Nothing makes sense time-wise anymore when you cover markets, of course, but I believe it was a few weeks ago, of course, with the collapse of Silicon Valley Bank, the ensuing crisis there. We got a series of backstops. One of them was one of those Sunday night announcements, the BTFP, or Bank Stop Funding Program. Talk to us about what that program entails, and why do you think that the Fed felt it was necessary to pretty quickly scramble all the pieces in place in what was pretty much a pretty quick weekend to kind of get this whole thing announced?
It's crazy. It's crazy how fast that happened. And it's crazy how fast the Fed actually snuffed it out. So, which to me actually isn't that surprising. I mean, they have all these programs that are kind of like ready, on the shelf, ready to implement because of what we went through with the financial crisis. The people may not even remember back in 08, 09. I mean, we implemented tons of lending facilities at the Fed that were really similar to what the recent backstop program was. And the basic gist of this one was that the way that especially banks like SVB, when they need to get money in the interbank market, which is the reserve market, where the way to think about this is that we all use the deposit market, which is the traditional banking system that we all think about. But when we settle a payment, for instance, if you bank at a different bank than I do, the way the two banks actually settle that payment is in the interbank market when they do that using reserves. And what happened with SVB, basically, in a nutshell, it's a little more complex than this, but in a nutshell, they couldn't obtain enough reserves to actually settle all of the payment outflows that they were getting. So they had so much of a huge outflow that they couldn't actually find the reserves to settle the payments in the interbank markets. And so they have to go to the Fed eventually to do that. And when they tried to do that, they didn't have the collateral to be able to actually post to borrow the reserves from the Fed. And the big part of that was that they were underwater on so much of their bond portfolio that the Fed basically looked at them and said, your collateral's no good because it's not worth 100 cents on the dollar. And you have to post stuff that is, 100 cents on the dollar, basically, in order for us to be able to allow us to lend to you in the first place. And so what this program basically did was it allows the banks to post this collateral as if it is worth 100 cents on the dollar, even though it may not immediately be worth it, because the Fed kind of knows that these banks mostly own treasury bonds and stuff that is going to be worth 100 cents on the dollar in the future, but may not be at present. So this program allows them to obtain the reserves necessary to clear these payments by posting sufficient collateral, basically.
Let's talk about that overlap then between Fed-backed reserves and the concern for hyperinflation. To combine your first two responses together, what is the link and what should people be looking for as maybe they now become a little bit more familiar to the idea of potential hyperinflation?
Yeah, so this is really important, especially with programs like quantitative easing and any of these lending programs, where I like to describe this sort of as, like the way I just basically explain this, that we use the deposit system. And so when the Fed is creating money in the interbank market, that money is basically, it's only used by banks. So it's kind of like a second layer behind what is the real payment system, which is the deposit system we all use. And when the Fed creates money in that market, it's not money that's going out and being used necessarily to buy groceries and things like that. So it's not necessarily something that can automatically have an immediate impact on prices in the sense that, for instance, deposit creation does. When banks create loans, they create deposits, and those deposits are literally new money that can go out and compete for things like groceries and whatnot. Whereas what the Fed was really doing here was they weren't actually creating money that was going to depositors. They were actually just allowing the banks to obtain money in the interbank market just so that customers can obtain the deposits that were literally already in existence. So allowing the banks to just clear payments in the second tier sort of interbank market, that this doesn't necessarily have an immediate impact, or it may not even have any impact in the long run on consumer prices.
Are you a fan overall of the either backstop measures or other responses we saw from the Fed since the issues with Signature, Silvergate, and then SVB?
How many hours do you have to debate whether it's good to have a central bank in the first place?
Hey, listen, we got a long weekend here, so I got as much time as you have. No, I'm kidding.
It's actually an interesting debate if you're a dork like we are, but I mean, I think the basic gist of it is that when you have a system where you have what is in essence a capitalist banking system, where you have these private entities that they compete to create loans, to create deposits, you inevitably have these environments where these entities fail on occasion. They make bad decisions. They make bad loans. They're not structured well like SVB was. They're not diversified like SVB should have been. And sometimes when those entities fail, you can find yourself in a situation that SVB's depositors were, where SVB's depositors didn't necessarily do anything wrong, but those people might be at risk of losing money because of something stupid that the executives did at SVB. And so that's really why central banks, or especially the Fed, was created in the first place. Was after the panic of 1907, what happened was the banks all were really exacerbating a lot of the economic problems that were occurring back then. And, depositors were losing money through no fault of their own. And that was creating literal depressions every once in a while in the banking system, because the banks were basically just inefficient at being intermediaries in essence. And so we created the Fed basically to act as like a backstop to come in and say, okay, hey, SVB maybe made a bad decision, but we're going to support the interbank clearing of what SVB is doing, because we don't think it's fair for SVB's bad decisions to impact JD just because JD banks there, and JD didn't do anything wrong. JD should be able to access his money regardless of what SVB did. And so you get into this whole debate about, is that a good thing? Is it a bad thing? You get into kind of like the Fed is hyper involved in a lot of ways where, it's good maybe that they protect depositors in an instance like this, but is it bad in the long run that they're doing lots of things that are sort of perpetually stimulative, leaving, interest rates at zero, sometimes making, decisions that entice people to actually take a lot more risk and be a lot more irrational than they otherwise would be. And that's just it's a super complex debate. And to be honest, I don't know. My general view is that I think the Fed for the most part is a good thing in that they don't allow SVB to impact the real economy just because SVB's, management makes a bunch of bad decisions. But at the same time, there's a lot of discretion. There's a lot of sort of guesswork in the way that the Fed operates with the way that they change interest rates and implement things like quantitative easing that I'm not a big fan of. I wish there was something more sort of systematic, automated, that didn't involve, Jerome Powell and a handful of other people just sort of sitting around in an ivory tower doing guesswork about what the future of the economy should look like, and thereby implementing an interest rate that they think may or may not be optimal for, the future of the economy.
To say nothing of the era of criticizing the Fed for this is just transitory, a whole other debate. But, sometimes my favorite questions about topics like these are ones that really require longer, more nuanced answers, which is why I appreciate the context with which you gave the last response. So thank you for letting me ask that. I guess this next question kind of goes hand in hand with that. Give me your sense about any concerns from regulators who are now taking a much closer look at the balance sheet from banks and the balance sheet health overall. Is there a threat that some of the actions of these regulators now moving forward might get in the way, might cause more harm than good?
Yeah, you could argue that the entire structure of the FDIC system now is a huge just moral hazard and just a real risk to the general economy in the broader sense, in that the interesting thing is that FDIC insurance was created basically to protect smaller banks. So they want smaller banks to be protected from these sorts of events where there are big runs on the small banks and people only use the big banks. But we've created this weird scenario in the USA where, especially after the financial crisis, where the government has kind of created this line in the sand where they're saying, okay, there are 8 big banks, and those are the 8 big banks that are globally systemically important. And we would never, ever let them fail. And so everybody kind of knows that too big to fail aspect of all this. But at the same time, they're now saying, in essence, that SVB and a lot of these smaller banks are also going to be basically federally insured. But now I think you've got this weird situation where people are still looking at the $250,000 FDIC insurance limit, and they're saying to themselves, okay, I bank at First Republic, and yeah, maybe the government is saying that First Republic is also too big to fail, but at the same time, I know for a fact that if I move my money to Bank of America, there's no way my money's at risk. So why would I even take the outlier risk that First Republic or some of these smaller banks might expose me to when I can just virtually guarantee that my money will be safe at Bank of America? And so you create this sort of weird scenario where FDIC insurance and the limitation of it actually creates this risk of like almost like not a bank run, but like a slow walk out of all of these smaller banks where people slowly are moving their deposits perpetually into just like the 8 biggest banks because people know, well, the US government is never going to let these 8 big banks fail.
Yeah, maybe and sometimes it feels a little bit more like a brisk walk. If you think about the days after this crisis first started coming out, we started to see the numbers by which how many depositors were basically going to a JP Morgan, feeling as if they're going to be far more structurally sound and secure than they would have for their more regional banks. And to your point, you got actually, let me a quick follow up on this. It sounds to me as if you're in the camp. I know we've heard from people like Elon Musk and fill in the blank here who say the 250 cap needs to be done away with. All deposits of all amounts need to be whole. And I assume from where you sit, that argument comes from the points that you just laid out.
Yeah, especially after something like SVB happens, where they come out and they basically already say, hey, all these deposits are going to be, they're all worth 100 cents on the dollar no matter what. It's the charade is kind of up at that point, where you start to realize like, oh, well, they can't actually let a huge amount of these deposits fail, because then, the whole monetary system kind of starts to get a run on itself, and you can't have that happening in the aggregate. And so they're in kind of a really weird situation, because they don't want to, I think, explicitly say that the federal government is on the hook for any potential losses of banks, because then, there really is no incentive for any of these small banks to be that safe in the first place. But at the same time, they have to support the banking system so that you don't get a widespread run on all these small banks, because that just causes a lot of turmoil economically in the long run. And so I think ultimately they'll either up the limit a lot, or they'll do away with it at some point. And that's kind of an interesting alternative scenario, where you still maybe get a huge amount of failures of these small banks, just because by that point, people are going to come to the same conclusion, I think, either way, where they're going to say, okay, well, even if there's no limit on the FDIC insurance, why would I even still leave my money exposed at this bank when I know for a fact that I can move it to one of the larger banks and just eliminate all of the uncertainty of whether or not, there's any sort of government regulatory mishap at any point along the way.
Let's draw this conversation a little bit back to 2008, learned lessons specifically from a similar program implemented by the Fed when the U.S. then was dealing with high instability within the banking sector. Was there an inflationary outcome that occurred at that era, or other learned lessons you think? Obviously, we want to be careful not to make a direct comparison, because we've had that conversation a lot over the course of the last month, and understandably so. I don't think the average depositor at any size bank who doesn't follow this stuff as closely in the weeds as we do is not going to know off the top of their head whether or not we're looking at a repeat or a 2.0 of 2008. But to the point about a similar Fed programs or Fed responses from '08, what should the learned lessons be, as at least we're dealing with the first major series of bank crises since that time?
Yeah. Well, I think the big one, and this is part of the lesson from SVB and the response that the Fed had there, is that the Fed is very much on top of this stuff. So the likelihood of something exactly like a 2008 occurring again, I think, is very low, because the Fed's got all these programs sort of in place on the shelf, ready to unfurl at, the first glimpse of something kind of going haywire. I think that the bigger lesson actually coming out of like 2008 compared to COVID, I think, was that when it comes especially to Fed programs and inflation, it's really mostly about government spending. So the difference between 2008 and the 2021 response from the government's level was that the Fed did a lot of the really, really similar programs. They ramped up QE in a big way. They did a lot of lending programs, things like that. The Fed's response wasn't that different. The government spending response was very, very different coming out of COVID. So we spent like, $7 trillion of deficit spending. That means spending in excess of tax revenue, basically, over the course of that 2-year period following COVID. Whereas in 2008, the entire rescue package was like $800 billion. It wasn't nothing, but it wasn't gigantic. And the difference between those two experiences was that inflation was actually pretty low coming out of the financial crisis, whereas inflation, as we all know, has been pretty, worrisomely high coming out of the COVID period. And I attribute a big part of that to the government's response in terms of spending. And so, when you think about the risk of inflation going forward, I think it's much more useful. A lot of people focus on the Fed and the sort of money printing narratives. I rarely like to describe the Fed as being the real money printer. The real money printer is the U.S. Treasury. They're the entity that they do the deficit spending, and it's really the bond issuance and the deficit spending that primarily contributes to excess inflation.
I appreciate that because I've actually caught myself and been surprised when I look back at the era of like the TARP bailouts around the GFC. And maybe it's just my years of because I was a Capitol Hill reporter before I covered markets again full time. And we are now mentally so used to pieces of legislation that have such bigger price tags than we
Hmm.
even had a decade or so ago. And we have a conversation about this. The dollar points are so much bigger. Granted, it's not a direct comparison in terms of traditional numbers. You talk 13, 14 years ago, but my goodness, have these numbers. I mean, we're in a whole different category, which does lead me to the next part of the conversation, the national debt. To your point, it's now north of $30 trillion. 6 years ago, it was only 20 and change. So we talk about a sizable boost in that figure, to your point, largely because of what we went through in response to the pandemic, 2020, 2021. We know where interest rates are at, just under 5%. A lot of Fed officials are signaling it's probably going to be at least 5.1, if not north, when all is said and done. Now, how does this whole conversation impact national debt payments and inflation, given the debt concerns you just laid out?
Yeah, it's interesting. I suspect that moving forward, the government has to be a lot more mindful of the impact of deficits and big government debt issuance. And I think that that's the big lesson coming out of COVID, really, that deficit spending and all this bond issuance and government spending is a huge contributor to the rate of inflation going forward. And so, how manageable is the national debt? I think that this is not a scenario, I think, where it necessarily causes a hyperinflation or even a continued high rate of inflation, because the deficits actually come down, I mean, quite a lot from the last few years. We're still doing, depending on how you measure it, I mean, $1 trillion a year, which that's still a big number. But historically, it's not something that is remotely consistent with like a hyperinflation or even necessarily a high inflation. I would argue that actually to get sort of a hyperinflation or even a 1970s style high inflation, you would have needed to have the COVID spending sort of continue in perpetuity. You would have had to have those sort of $3 trillion deficits like almost every year for a really long period. And so we kind of got like one big splash of that, and we're seeing the inflationary impact of that. But I think the proper way to think of that is that what really happened was it bumped us into like a new equilibrium. It bumped us up to a new price level in terms of where inflation is at, but you're not getting a continued increase in that necessarily, or at least at the same rate of change, because you're not getting the same perpetual response from the government, which is what would generally cause something like that to happen. So, going forward, I think that especially if these politicians want to keep their jobs, I think they have to be super mindful of inflation, because that's the other thing. The other big lesson coming out of the last few years is that consumers are hypersensitive to even like a 5 to 10% rate of change in inflation, as they should be. And I think politicians are really hyper aware now that the decisions that they make are direct contributors to the prices that consumers ultimately pay, and that puts their jobs at risk if they just are perpetually reckless with the way that they're spending going forward.
A lot of spending during an anomalous time of a public health crisis, no doubt. The old joke on Capitol Hill is that the only people who ever care about how much spending goes on is whatever party is not in the majority at any given point. And then as soon as you get the gavel back, suddenly your tone starts to change. You start to sing a little bit of a different tune. Cullen, you look around and you say, well, we had our spending priorities and they
Right.
got their they got their piece of the pie. We now want our piece of the pie. And I don't know, it'll be interesting to see how the rest of this Congress and the next several Congresses continue to deal with the repercussions. My man, I could have this conversation with you all afternoon, but it is a 3-day weekend for markets here. I wish you the best for the long holiday weekend. Cullen Roche is CIO at Discipline Funds. Thanks a lot, and thanks for taking the time. Nice to have
Yeah,
you.
great talking. Thanks for having me.